The microcap equity market operates with high levels of volatility and systemic inefficiency. In this space, standard financial logic often yields to unpredictable variance. Traditional analysts frequently make the same error, attempting to apply fundamental valuation metrics to companies that, by most objective standards, possess little to no institutional-grade value. We categorize the baseline state of this market as the snore or messy chart. This represents a period of non-actionable price movement. You can identify a messy chart by its visual footprint, frequent random trend changes, with negligible liquidity and a total lack of market consensus. This graph illustrates the lack of correlation between price and actual data. In these assets, the price often drifts regardless of information flow. When random variance is the default state, extracting predictive data from the chart becomes a statistical challenge. For most of these stocks, the movement is simply noise. Finding actionable signal in microcap equities requires filtering out 90% of the price action. Rather than corporate analysis, we shift our focus to hunting for specific geometric patterns created by extreme supply and demand shocks. Take this floating oil rig. It represents the type of physical, fundamental asset that analysts use to justify a company's valuation. However, a successful technology test on that rig only impacts the market if it triggers a mechanical surge in volume. Without that surge, the asset's physical reality is disconnected from its stock price. These volume surges produce clean geometric breakouts. These patterns reflect the immediate laws of supply and demand, rather than long-term fundamental math. Isolating these geometric signatures allows us to identify moments where structural imbalances in the market create exploitable trends. The most volatile structural imbalance is the demand shock, identified visually as the supernova. It begins with a seemingly stable uptrend in a low-float equity. This trend accelerates when an external catalyst, such as a newsletter promotion, enters the ecosystem. The critical point occurs when the resistance breakout is confirmed by a disproportionate spike in volume. Momentum algorithms and retail hype then force the price into an exponential climb, moving vertically as buyers compete for a limited number of shares. But because this climb is driven by a temporary shock rather than fundamental growth, a significant collapse is statistically likely. The resulting cliff-like drop is the result of a specific behavioral loop, the stop-loss cascade. Most retail stop-loss orders cluster at round numbers, like the $15 mark. When the price hits 15, these orders dump massive supply into a market with few buyers. The price plunges to 14, which in turn triggers the next wave of automated sell orders. Attempting to trade against this drop is extremely difficult. In a stop-loss freefall, liquidity can vanish, allowing the price to sink through multiple levels before an order is filled. The inverse of the demand shock is the supply glut, known geometrically as the crow. The crow is defined by a relentless, gradual decline. It isn't a sharp panic, it's a methodical picking away of the asset's price over several months.
This pattern often signals that a major institutional holder is liquidating shares, perhaps following a defaulted loan or a change in fund strategy. This seller creates a persistent supply ceiling. Every time the price attempts to rise, this institutional selling absorbs the demand and halts the recovery. Traditional analysis suggests that a major macro catalyst, like a bird flu pandemic, should reverse this trend by generating new biotech hype. But while retail buyers flood in on the news, the institutional seller uses that new liquidity to liquidate their position even faster, keeping the price suppressed. We can see this in the timeline. The company reports an earnings beat, then a major contract, yet the price continues to drop directly through these positive triggers. In a crow pattern, the geometric trend often overrides the headline news. A persistent supply glut can prevent even positive fundamental developments from reflecting in the stock price. The third archetype is the stair-stepper, which acts as the bridge between explosive momentum and a slow decline. Its structure consists of long periods of sideways consolidation, followed by sharp, stepwise shifts in volume and price. This pattern suggests the market is slowly processing a change in the company's long-term equilibrium. For example, a sudden conflict in a combat zone may create a long-term need for military supply contracts, changing a defense company's outlook. In an illiquid market, this change isn't processed as a smooth curve. Instead, we see a rigid step up as orders are filled, followed by months of stagnation. The stair-stepper illustrates that even legitimate fundamental shifts are often processed through mechanical steps that can trap impatient investors. Technical analysis in these markets isn't about predicting a company's corporate future. Instead, reading this geometry allows us to identify where other market participants are being mechanically trapped by order flow. We map this on a matrix: y-axis, liquidity; x-axis, price action. The messy chart occupies the low liquidity random walk quadrant. The supernova sits in the high liquidity directional momentum zone. This high liquidity quadrant is the only environment where supply and demand reliably override random noise. To survive this asset class, we must avoid the low liquidity quadrants entirely and focus exclusively on the high signal zones. These archetypes allow us to establish a set of strict operational rules. Rule 1: never trade in front of earnings or news. Always wait for the release and trade the mechanical momentum of the reaction. Rule 2: never attempt to catch a falling supernova, and never assume a declining crow is about to recover based on its valuation. The company's products and operations are secondary to how the market processes them. Order flow is what dictates the price, regardless of the intrinsic value implied by the product. This split screen highlights the contrast. On the left is the directionless noise of a messy chart. On the right is the clean, high-volume breakout of a supernova. Mastery of this market requires shifting your focus away from intrinsic value and toward the exploitation of clean, structural imbalances in order flow.